The question of whether China is on the brink of bankruptcy has gained traction amid its economic turmoil, particularly following the collapse of its real estate sector, which contributes significantly to the nation's GDP. As of early 2025, various analyses and projections paint a complex picture of China's economic future, revealing both immediate challenges and long-term implications. Current economic landscape. China, the world's second-largest economy, has faced significant hurdles recently. The real estate sector, which accounts for approximately 30% of GDP, began to show signs of distress in 2021 when the government imposed restrictions to curb excessive borrowing among property developers. This led to a substantial decline in construction activities, resulting in halted projects and a ripple effect on related industries. By 2024, official GDP growth rates had stagnated to just 3.2%, significantly below government targets. Retail sales have also stagnated. And youth unemployment has surged to a staggering 21%. The CSI 300 index, which tracks the performance of the largest companies listed on the Shanghai and Shenzhen stock exchanges, has experienced a decline for 4 consecutive years, reflecting waning investor confidence. Financial strain and debt issues. China's banking system is under considerable strain, primarily due to local government debts estimated at a staggering $23 trillion. Many local governments rely heavily on land sales for revenue, which has become unsustainable as the real estate market falters. This situation has led to a crisis for local governments, with reports indicating that salaries for public employees in some provinces are at risk of being unpaid. The financial landscape is further complicated by deflationary pressures and negative wealth effects stemming from the failing real estate market. As property values decline, household wealth diminishes, leading to decreased consumer spending and a reluctance to invest. This creates a vicious cycle that exacerbates the economic downturn. Government response and economic policy. President Xi Jinping's administration has attempted to pivot the economy towards high-end manufacturing and technology, aiming to replace the faltering real estate sector. However, critics argue that these measures have not been sufficient to stimulate broad economic recovery. The government's focus on state-owned enterprises (SOEs) at the expense of private businesses has drawn criticism, as private enterprises are crucial for job creation and economic growth. Despite the dire situation, some analysts contend that China's trade surplus, approximately $1.1 trillion annually, and significant foreign reserves provide a buffer against immediate bankruptcy. However, the consensus remains that systemic reforms, particularly those favoring the private sector, are essential to prevent prolonged economic stagnation. Global implications. The implications of a potential economic downturn in China are significant on a global scale, given that China accounts for roughly 30% of worldwide economic growth. Economists warn that sustained economic instability in China could precipitate broader financial crises across the globe. Moreover, there are concerns about how domestic unrest might lead to increased geopolitical tensions, particularly regarding Taiwan and regional security. Timeline of events and future outlook. 1. 2021, the onset of the real estate crisis. 2. 2023, the lifting of the zero-COVID policy briefly revitalizes the economy but fails to address underlying structural issues. 3. 2024, economic growth stagnates at 3.2%, with rising youth unemployment exacerbating societal tensions. Looking ahead, predictions for China's economic future vary widely. Some analysts foresee a prolonged recession if significant reforms are not implemented, while others remain cautiously optimistic, citing the country's underlying economic fundamentals as potential stabilizers. Conclusion. In summary, the outlook for China's economy is characterized by uncertainty and significant challenges. The interplay between government policies, the vulnerabilities of the real estate market, and global economic dependencies will ultimately dictate the trajectory of China's economic health. While immediate bankruptcy may not be on the horizon, the need for reform and a shift towards a more balanced economic model is critical to avert deeper crises in the future. The world watches closely as China navigates these turbulent waters, with the consequences likely to resonate far beyond its borders. The question of whether China is on the brink of bankruptcy elicits a range of responses, often colored by geopolitical perspectives and economic theories. Here are some counterintuitive insights drawn from recent analyses. 1. Resilience amidst crisis. While many analysts predict an impending collapse due to China's economic troubles, some argue that China's vast trade surplus and substantial foreign reserves act as a buffer against immediate bankruptcy. This perspective counters the narrative of an imminent financial disaster, suggesting that despite underlying issues, the country's economic structure allows for a degree of resilience. 2. State-owned enterprises versus private sector. The focus on state-owned enterprises (SOEs) as the backbone of China's economy under Xi Jinping may seem logical given their size and government support. However, this prioritization over private businesses, which are crucial for employment and innovation, could paradoxically hinder economic recovery. Critics argue that the government's reluctance to support private sector growth could lead to prolonged stagnation, which is a more insidious threat than outright bankruptcy. 3. Demographic challenges. The perception that China's economic model is invulnerable is countered by the significant demographic challenges it faces, such as an aging population and low fertility rates. The expectation that a rapidly growing middle class will drive consumption is undermined by the reality that many households are overly dependent on real estate wealth, which is now declining. This could lead to a decrease in domestic consumption, challenging the narrative that China will continue to be a significant driver of global economic growth. For ticking time bomb analogy, the characterization of China's economy as a ticking time bomb suggests an imminent explosion of problems. However, this analogy can be misleading. Rather than a sudden collapse, many experts foresee a slow, drawn-out period of economic malaise. This slower decline could be just as damaging, both for China and for global economic stability, as it allows for the gradual accumulation of systemic risks that could eventually lead to a more catastrophic failure. 5. Reforms versus stagnation. The prevailing narrative suggests that China must undergo significant reforms to avoid economic disaster. However, some analysts believe that the Chinese government could manage to navigate its challenges without drastic changes to its policies. This view posits that while the economy may not thrive, it might not collapse either, allowing for a prolonged period of stagnation instead. 6. A global interdependence. The expectation that China's economic collapse would trigger a global crisis overlooks the complex interdependencies of modern economies. While a downturn in China could indeed have significant repercussions globally, the world is more resilient than it was during previous crises. Many economies have diversified their dependencies since the 2008 financial crisis, which could mitigate some of the impacts of a potential slowdown in China. 7. Public sentiment and consumption. The assertion that consumer spending will resume if confidence returns contradicts evidence that consumer sentiment is deeply tied to wealth, particularly in real estate. The idea that simply restoring confidence will lead to a quick revival in spending may underestimate the psychological impact of the current economic realities and the cultural behaviors surrounding saving versus spending, particularly in a society where many are now more risk-averse. 8. Military diversion. The speculation that economic distress could lead to military aggression, particularly towards Taiwan, presents a paradox. While some analysts suggest that a failing economy might push China to act aggressively abroad to divert attention from domestic issues, this could also backfire by further isolating China internationally, complicating its economic recovery. In essence, while the prevailing narrative around China's bankruptcy suggests an immediate crisis, a closer examination reveals a more nuanced situation where underlying structural issues may lead to a prolonged period of economic stagnation rather than an outright collapse. The question of whether China is on the verge of bankruptcy is multifaceted, with various perspectives offering insights into the underlying economic conditions and potential outcomes. While many discussions focus on the immediate indicators of distress, certain significant aspects and underlying trends often get overlooked, which may have profound implications for both China's future and the global economy. 1. Local government debt and its consequences. One of the most critical aspects that often gets overlooked is the scale of local government debt. Estimates suggest that local governments in China are burdened with approximately $23 trillion in debt. This staggering figure represents a significant portion of China's GDP and raises serious concerns about the sustainability of local government finances. The reliance on land sales for revenue has led many local governments into a precarious situation where they are unable to meet their obligations, leading to potential defaults. Significance: the implications of local government debt are severe. If these governments face bankruptcy, it could lead to a collapse in public services, further destabilizing the economy and eroding public trust. This situation could trigger unrest and undermine the Communist Party's legitimacy, as citizens may find themselves deprived of essential services like education and healthcare, which are often funded at the local level. 2. The real estate sector's overcapacity. China's real estate sector, which has been a cornerstone of its economic growth, is currently experiencing significant challenges. The sector accounts for about 30% of the GDP, and the collapse of this bubble is not merely a financial issue but a broader economic malaise. Analysts have pointed out that there is an oversupply of housing, many properties are unoccupied or ghost towns, leading to a depreciating asset base for many households whose wealth is heavily tied to real estate. Significance: the real estate crisis goes beyond just market fluctuations. It reflects a systemic issue in China's economic model, where speculative investment in property has overshadowed the development of productive assets. As property values decline, household wealth diminishes, leading to reduced consumer spending and potential deflation. The failure to address these structural issues could result in prolonged economic stagnation, impacting global markets due to China's significant role in international trade. 3. Demographic challenges. Another critical factor often overlooked is China's demographic trajectory. The one-child policy has resulted in an aging population and a shrinking workforce. Older population can sustain high levels of economic growth is unrealistic. This demographic crisis could undermine China's potential to recover from its current economic malaise and could lead to a long-term decline in its global economic position. 4. State versus private enterprises. The current economic policies under Xi Jinping, characterized by a preference for state-owned enterprises (SOEs) over private companies, are also pivotal. The discrimination against private businesses has stifled innovation and economic dynamism, which are crucial for sustained growth. Private enterprises are responsible for a significant portion of employment and GDP contribution but face increasing regulatory hurdles and pressure. Significance: the future of China's economy hinges on its ability to foster a vibrant private sector. If the government continues to prioritize SOEs, it risks creating a stagnant economic environment that lacks the flexibility and innovation necessary for recovery. This situation could lead to increasing unemployment and social discontent, further destabilizing the regime. 5. Global supply chain dependencies. China's role in the global supply chain is another critical aspect that often gets understated. As the world's largest manufacturing hub, disruptions in China's economy could have ripple effects across various industries worldwide. The interdependencies mean that a slowdown in Chinese production can lead to shortages and increased prices for goods globally. Significance: global economies are intricately linked to China's economic health. A significant downturn in China could disrupt supply chains, leading to inflationary pressures in other countries. This scenario could force governments and businesses worldwide to reconsider their dependencies on Chinese manufacturing, leading to a re-evaluation of global trade dynamics and potentially accelerating the shift towards regional supply chains. 6. Government response and policy inertia. The Chinese government's response to these challenges has been criticized for its lack of decisiveness. While there have been attempts to pivot towards high-end manufacturing and technology, the reluctance to implement expansive fiscal stimulus measures akin to those used during past crises raises concerns about the government's commitment to stimulating demand.
Significance: the absence of a robust response to economic challenges may prolong the downturn.
Without significant reforms to stimulate consumption and support private enterprises, China could face a prolonged period of stagnation. This situation not only threatens domestic stability but could also lead to increased geopolitical tensions as the Communist Party seeks to divert attention from economic woes through nationalism or aggressive foreign policy.
7. Potential for political instability. Finally,
the socio-political ramifications of economic decline are significant but often underestimated. Economic hardship can lead to social unrest, and as citizens grow increasingly frustrated with the government's handling of economic issues, the potential for protests and political instability rises. Significance: the Communist Party's legitimacy is closely tied to economic performance.
A significant economic downturn without adequate government response could erode public support and lead to civil unrest.
The potential for unrest could also prompt the government to adopt more authoritarian measures to suppress dissent, leading to a cycle of repression and resistance that could destabilize the regime.
Conclusion.
In summary, the question of whether China is on the brink of bankruptcy involves intricate dynamics that extend beyond immediate economic indicators. The overlooked aspects, including local government debt, the real estate crisis, demographic challenges, the role of private enterprises, global supply chain dependencies, government response, and political stability,
are crucial for understanding the broader implications of China's economic trajectory.
Addressing these issues is essential for China to navigate its economic challenges and avoid a potential crisis that could have far-reaching consequences for the global economy. 1. Economic indicators and the real estate crisis. A critical point of discussion revolves around the significant downturn in China's economy, primarily attributed to the collapse of its real estate sector, which constitutes about 30% of the GDP. The onset of this crisis began in 2021 and has led to a stagnation in retail sales and a troubling youth unemployment rate of 21%. The decline of the CSI 300 index over 4 consecutive years reflects diminishing investor confidence and signals potential long-term economic distress.
Analysts express concerns that without intervention, this stagnation could evolve into a prolonged recession affecting not just China but the global economy. Given that China accounts for roughly 30% of worldwide economic growth.
2. Government economic policies and Xi Jinping's leadership. The approach taken by Xi Jinping's administration, often referred to as Xiconomics, has come under scrutiny. The government's preference for state-owned enterprises (SOEs) over private businesses has raised alarms, as private enterprises traditionally drive GDP growth and employment. The lack of a comprehensive stimulus plan, which has been a characteristic response in past economic downturns, exacerbates fears of a systemic failure. Critics argue that without meaningful reforms favoring the private sector, China's economy may languish in stagnation,
unable to adapt to the changing global landscape. 3. Global economic implications. China's economic trajectory is not only pivotal for its own citizens but also for the broader global economy. An economic downturn in China could trigger worldwide financial crises due to interconnected trade and investment relationships. The potential for geopolitical tensions, particularly concerning Taiwan, could also arise from domestic economic distress.
Analysts highlight the need for vigilance, as the repercussions of a collapsing Chinese economy could destabilize not only its immediate region but also global markets.
For future outlook and predictions, the outlook for China's economy remains uncertain, with predictions diverging widely.
While some sources suggest that China could face prolonged recessionary conditions, others argue that its substantial trade surplus and foreign reserves provide a buffer against immediate bankruptcy.
The consensus emphasizes the necessity for systemic reforms in the economy,
particularly in favor of the private sector. Without such changes, the risk of economic stagnation persists, suggesting that the trajectory towards potential bankruptcy could be contingent on policy shifts and economic management strategies. In conclusion, the factors leading to the potential bankruptcy of China encompass a combination of economic indicators, government policy, global implications, and future outlooks, creating a complex landscape that warrants in-depth analysis and discussion. 1. The collapse of the Soviet Union. 1991. The Soviet Union's dissolution in 1991 serves as a prominent historical example of a state facing economic collapse. A combination of political, economic, and social pressures led to systemic failure. The economy suffered from inefficiencies in its centralized system, a lack of consumer goods, and mounting debts. The Gorbachev-era reforms, including perestroika and glasnost, aimed to revitalize the economy but ultimately destabilized the existing system. The rise of nationalism in various Soviet republics further complicated the situation, leading to the eventual breakup of the USSR into independent states. The economic turmoil and transition that followed had significant global implications, marking the end of the Cold War and the emergence of the US as the sole superpower. 2. The Great Depression. 1929 to 1939. The Great Depression is another example of a severe economic collapse that had profound effects worldwide. Following the stock market crash of 1929, the U.S. economy plunged into a decade-long depression characterized by massive unemployment, widespread bank failures, and significant declines in industrial output. The economic downturn spread globally, affecting countries that depended on American trade and investment. Governments initially employed austerity measures which exacerbated the situation, leading to widespread hardship. The eventual shift towards more interventionist policies, including Franklin D. Roosevelt's New Deal, represented a significant change in economic thinking and set the stage for modern welfare states. 3. The Greek debt crisis. 2009-present. The Greek debt crisis is a contemporary example of an economy on the brink of collapse. Following the global financial crisis of 2008, Greece faced an unsustainable debt level exacerbated by structural weaknesses in its economy and government mismanagement. In 2010, Greece required a bailout from the European Union and the International Monetary Fund to prevent default. The subsequent austerity measures imposed on Greece led to severe social unrest, high unemployment, and a deep recession. The crisis raised questions about the viability of the Eurozone and the implications of economic interdependence among member states, highlighting the challenges of monetary union without fiscal unity. Greece's economic struggles continue to resonate in discussions of European economic policy and reform. The prospect of China facing bankruptcy has become a topic of significant debate, driven by economic challenges and shifting policies under President Xi Jinping. While some analysts predict an imminent collapse, others argue that China possesses sufficient economic buffers to avert immediate bankruptcy. Here's a comprehensive outlook on the future of China's economy and the potential implications of its challenges. Current economic landscape. 1. Real estate crisis. The collapse of the real estate sector, which represents about 30% of China's GDP, has been a pivotal factor in the economic downturn. The crisis, triggered by excessive borrowing and overbuilding, has left many projects unfinished and local governments in financial distress. As a result, consumer confidence has plummeted, and retail sales have stagnated. 2. Debt levels. Local government debts are estimated to be around $23 trillion, with many provinces struggling to meet financial obligations. This situation has led to concerns about the stability of the banking system, as local banks are heavily intertwined with government financing vehicles. 3. Youth unemployment. The youth unemployment rate has soared to 21%, reflecting a lack of job opportunities and contributing to social discontent. This demographic challenge poses long-term risks to economic stability and growth. Policy responses and economic strategies. 1. Shift in focus. In response to the real estate crisis, Xi's administration has pivoted towards high-end manufacturing and technological innovation. However, this transition may not be sufficient to stimulate immediate economic recovery, especially as the private sector has been sidelined in favor of state-owned enterprises SOEs.
2. Stimulus measures. While some economists advocate for a robust stimulus plan to enhance consumption, the government has been hesitant to implement large-scale fiscal measures.
This reluctance stems from a desire to avoid creating further debt and from ideological constraints associated with Xi's economic policies.
3. Global trade surplus. China maintains a significant trade surplus, approximately $1.1 trillion annually, which acts as a buffer against economic shocks. This surplus, combined with substantial foreign reserves, provides some reassurance regarding the immediate risk of bankruptcy.
Predictions for the future.
1. Prolonged economic stagnation. Many analysts predict that without systemic reforms favoring the private sector, China could experience a long period of stagnation.
Economic growth rates have already fallen below government targets, and projections indicate that growth may remain subdued for years to come.
2. Geopolitical implications. A prolonged economic downturn in China could lead to heightened geopolitical tensions, particularly in relation to Taiwan and the South China Sea. Economic instability might prompt the Chinese government to adopt more aggressive foreign policies as a means of consolidating domestic support. 3. Demographic challenges. China's aging population and declining birth rates pose significant long-term challenges. With a shrinking workforce and increasing dependency ratios, the economy may face pressures that further complicate recovery efforts. For potential for reform, there is a possibility that the Chinese government might eventually recognize the need for economic reform if current policies fail to yield results. Historical precedents suggest that drastic policy shifts can occur when the regime feels threatened, although such changes are often slow to materialize.
Conclusion. In conclusion, while the notion of China going bankrupt may be exaggerated in some quarters, the country faces considerable economic challenges that could lead to prolonged stagnation rather than outright collapse.
The interplay between domestic policies, demographic shifts, and global economic conditions will shape China's economic trajectory.
Without significant reforms to stimulate private enterprise and consumer confidence, the country may struggle to regain its previous growth momentum.
The potential repercussions of a weakened Chinese economy extend beyond its borders, underscoring the interconnectedness of the global economy.